Okay, I'm back. So most important is, how do we use this information? Hopefully that'll help you to understand. So since we have product costs for both the absorption and the variable methods, now we need to create an income statement using the absorption income statement and then with the variable income statement. So I'm going to add some information right here, and that'll be that 35,000 units are sold. So we're just going to add that information because we need it for the income statement. And not only do we need that, we need a selling price. So I'm going to determine that the selling price is $40. $40 per unit selling price. So that's going to help us a little bit. Okay, so how do we calculate revenue? Well, it's going to be the 35,000 units sold multiplied by the $40 of selling price per unit. So 35,000 multiplied by the $40 per unit. And let's make certain that everything looks good. There we go, we got some dollar signs there. Now we're going to calculate and use the product cost that we just calculated for the absorption method. So if we sold 35,000 units, then we need to also show the product cost for 35,000 units. We're not going to use the units manufactured because that's going to be, some of that will be left on the balance sheet or ending inventory. So with that said, 35,000 units multiplied by our total product cost under the absorption method. So that's going to be 1,085,000. Now you're probably wondering why I wrote it in twice. I want you to see how it's calculated, and I indented it because I wanted to make a point. You'll see under the variable. So our gross profit is going to be our revenue less the total cost of goods sold. So right now we're at $315,000. We need to reduce this amount, this gross profit amount, by the variable selling and administrative costs and the fixed selling and administrative costs. So the variable selling and administrative cost is actually $4 per unit was given, and we need to multiply that by 35,000 units sold. Our fixed selling and administrative was given to us as $25,000. So let's add up these two selling and administrative amounts. And the total selling and administrative is going to be $165,000. So to calculate net operating income, we're going to take gross profit and subtract it from total selling and administrative. So under the absorption method, our net operating income is $150,000. I'm going to pause and set up the income statement for us in order for us to prepare the income statement using the variable method. Hang tight. Hi, I'm back. Probably seemed like just a moment to you. So I thought I would put the absorption income statement here in yellow. I was thinking SpongeBob. And then the variable income statement right here in green. So let's begin work on it. So the revenue, again, is the units sold multiplied by the price, the selling price per unit. So we have 35,000 multiplied by $40 per unit. And I forgot to put, there we go. I've got the formula right now. So you'll notice that revenue for both the absorption and for the variable method, they're exactly the same. Units sold multiplied by selling price. Now, the cost of goods sold, or specifically the cost of the product, is going to be, once again, $35,000, but this time we're going to multiply it by the variable cost per product, or the variable product cost. In addition, under the variable income statement, we not only add the cost of the product, we add the variable cost of selling and administrative. If you stretch your memory a little bit, you'll remember we talked about this in Chapter 2, Chapter 3. So once again, $35,000, or excuse me, 35,000 units multiplied by our variable selling and administrative, $4. So the total cost of goods sold is going to be these two, the cost of the product and the variable cost of selling and admin, or $1,155,000. Now, revenue less total cost of goods sold is not gross profit under variable, instead it's contribution margin. So let's take revenue subtracted by the total cost of goods sold, and our contribution margin is $245,000. Now, here are our fixed costs. Manufacturing overhead fixed is the $80,000, which was given, and variable selling and admin is the $25,000, which was given. Let's add the two fixed costs together, and that equals $105,000. Net operating income is the $245 less the $105, and net operating income is $140,000. So you might be saying, how can I check that number, Lenore? How can I possibly reconcile this number? Glad you asked that, because there is a way we can reconcile it. So I'm going to call reconciliation. And remember from your bank statement days, or bank reconciliations, we need two different pieces of source data, and they should add up exactly the same. So, for our reconciliation, one of our source data's points is absorption net operating income. And that's this 150,000. And we're going to compare that to the variable net operating income that we just calculated, which is the $140,000. So our variance between the two that we're going to use for our reconciliation again is the difference between the two, or $10,000. So we need to explain that $10,000. Here's how we do it. We take the total number of units manufactured had to slow down there because I couldn't remember how to spell that, which is 40,000. And from this, we're going to subtract the total number of units sold. Which is 35,000. So this is the unit variance. this. So the unit variance is units manufactured less units sold. So this unit variance could also be imagined, or is also the same as ending inventory. Because if we manufactured 40,000, we only sold 35, we would have 5,000 left. So this unit variance is the same as your ending inventory. Now we're going to multiply this unit variance by this item right here, because that's the difference between the two. The fixed manufacturing overhead. So let's fixed manufacturing overhead, and that's $2. So we're going to multiply again our 5,000 units by our fixed manufacturing overhead, and this is the second part of our reconciliation. So we need these two numbers to agree in order for us to reconcile the difference between the two net operating incomes. Voila, $10,000. So the fact that this $10,000 is here and this $10,000 is here means that we've calculated it correctly. The reconciliation between the two net operating incomes is always the unit variance, so the unit difference between those units manufactured less those units sold, multiplied by the fixed manufacturing overhead that we've calculated for the absorption method. So with that, I hope this helps you through this chapter. I will continue making podcasts, doing actual exercises. So with that said, Lenore out.